Hi, everybody. Welcome to our second part of our retirement series. So, first off, I want to thank all of you for writing in with suggestions and writing in with questions. Rest assured, we're going to be covering all of those questions, but we're just going to go in a sequential manner so that everyone's on the same page and everyone's talking the same language. Because a lot of you have written in about specific product types and how to think about those products. We'll definitely discuss them. We'll discuss life insurance policies. We'll discuss annuity products, etc., pensions, etc. But I want to establish the framework so that we can analyze those products properly. So those will come in future installments. We're just trying to lay the groundwork here so that everyone's on the same page and is comfortable using Excel to answer some of these questions. Basically, any questions that we have can really be tackled very well in Excel. And I want to get everyone comfortable playing around in Excel, using it and seeing the power of the product to help us answer seemingly impossible questions. So let's get started with today. So quick recap of last time. In case anyone's not seen last session, please go to YouTube and check it out. It's really important, and it's a very good introduction to how we're going to be framing the series. So we basically discussed our approach in the series where we're going to be looking at Excel and math to understand the mechanics of retirement and abstracting from that to general principles. We're not just going to be talking about general principles, because my belief is that if you really understand the nuts and bolts, then the principles are going to be motivated for you and you're going to actually understand why those principles make sense. And you'll be much more likely to adhere to them, etc. So we walked through what retirement means. Simply, it's when you rely on your corpus to fund all of your expenses. You no longer have an active source of income. We also introduced how Excel can be used to answer some really, really difficult questions. So we walked through a couple of examples around using the present value formula and the PMT formula. You can check out again last session and download the Excels to go through those formulas. And we reviewed some key principles that we derived from that Excel work. So what are we going to cover today? So we're going to be focusing on a key part of the retirement math that we walked through last time. So as you can see below, this was the spreadsheet that we looked at. And a key part of that is what is the corpus's size and what is the rate of return on the corpus. We're going to be focusing on the corpus in today's session and probably next session as well. So what are we going to try and tackle? We're going to try and understand what is the function of the corpus, what we need to track on the corpus and why, and how we can use Excel to track and make better decisions regarding our corpus. And again, we're going to derive a few general principles once we play around a bit in Excel. And then I'm going to leave you today with a little bit of a preview of where we're going in our next section, which is going to talk about how do we think about risk and how do we bring risk into our Excel work. So that's kind of the agenda for today. So let's start with the functions of the corpus. So obviously one of the key functions of the corpus is it has to provide us the income that we need to live comfortably in retirement. So you can think of the corpus really as the raw material for our income. It's the kind of fuel that we need to generate our lifestyle in retirement. And how well we use that fuel comes down to the return that we generate on that corpus. The second function that the corpus needs to provide is also a safety net. We don't know what life has in store for us, and we're just guessing, and there's lots that can go right, wrong, and we need to have excess funds to cover eventualities. So the corpus also needs to be a relatively safe pool of capital for us. And protecting the corpus is important because it's not easy to get new inflows of cash when you're retired. No one wants to go out of retirement once they've retired. So it's important to think about the corpus as a relatively risk-averse pool of capital. Okay, so the first step that we need to do and everyone should do in terms of figuring out how to deploy their corpus is first understanding and quantifying the corpus. How do we know how large our corpus is? How do we know what it consists of? What items should we include? What items should we exclude? This may sound really trivial and easy, but it actually may be very complicated depending on how complex a life you've lived and how complexly you've saved and invested in the past. So, and there actually may be good news for a lot of people because there may be sources of funds in your corpus that you weren't aware of. But if you go through this process, you may identify hidden sources of wealth in your portfolio. So what do we care about in terms of the corpus? We want to list all of your liquid assets. So what does that mean? It means it's something that you can convert to cash relatively easily. And it means something, therefore, which is not essential to your lifestyle. It can be sold without impairing your quality of life. So what I mean is, let's say you live in a house, right? And that house is worth 2 crores. That house is not really part of your corpus because it's essential to your lifestyle. You wouldn't sell that house. You don't want to be in a position where you're going to sell that house. So that would not be counted in your corpus. Your corpus consists of things that are superfluous to your lifestyle. You're willing to sell them. You're willing to convert them into cash. So basically, we're after your stores of wealth. So let's take some examples. You have some obvious ones here: stocks, bonds, mutual funds, investment properties you own, FDs, cash in the bank, life insurance saving schemes. These are all things that are parking lots for your wealth. Your lifestyle doesn't get impaired if you convert your FDs into cash or you convert your life insurance saving scheme into cash. So these are just basically stores of wealth. But here are some less obvious ones. So what if you have a second car that you don't really use now that you're retired? Well, that could actually be a part of your corpus because you don't mind selling it and converting it into cash if you're not using it. Well, maybe you have a vacation home. Maybe that is something that you don't use as much as you thought. That could also be a part of your corpus. So what probably isn't a part of your corpus? So let's say jewelry that your wife enjoys wearing, you can't sell that without causing an impairment in your quality of life. So that would not count. Your primary home, you can't sell that again without a impairment in your quality of life. So that kind of is the items that we're trying to identify in everyone's life and portfolio. So what details do we care about when we're trying to quantify the portfolio? Well, the first is the value. So we really want to know how much would you get if you chose to convert the asset to cash today? So again, this sounds simple, but it may actually be a little counterintuitive for people. So for example, you may have a life insurance policy that contractually pays you 1 crore at maturity of the policy, but its surrender value may be less than 1 crore. It may be, say, 50 lakhs. So if you wanted to convert that asset into cash today, you would have to take the surrender value, not the future value. So what we really care about and noting is how much would you get if you converted that asset into cash today. So this is something that's pretty easy to calculate for mutual funds, stocks. You just look at the value of the holding at that point, but it can be a little trickier for some other asset classes. For a home, for example, you will need to put it at the current market price, and there'll be some judgment there, obviously, that you'll need to use. Then we care about the type of the asset. We want to be able to look at how much of your assets are in equity, debt, or other types of assets as we think about risk in a portfolio. So you also want to note down what kind of asset it is. So basically, that's also critical to understanding the asset allocation strategy. The next thing that we care about is what return do we expect on these assets in the future? When we're reviewing our corpus, we want to know, does it make sense to have this asset in our portfolio? So to do that, we need to make some guess as to how well or badly it will perform in the future. We also want to know, is there any steady cash income you're getting from the asset? So this could be dividends from stocks that pay dividends or mutual funds that are paying you dividends, or it could be interest payments from bonds or debt mutual funds, or it could be rent payment you're collecting from a second property. But we really want to also know how much cash these assets are providing. And there are a few more topics that you could also track that we're going to cover in the future as we deal with some more advanced aspects of this. So one is the risk, which we're going to deal with in the next session. And then also taxation. Is the asset, if you sell it, going to cost you long-term capital gains or short-term capital gains? That's another thing that we'll cover in a future session. But for now, we're going to ignore those two details and try to do all the other things on this sheet in a very effective manner. So what is the goal of all this? Why are we spending time trying to understand the corpus? Well, it's going to enable us to determine our asset allocation. When we're retired, we really need to make sure our portfolio is achieving the right level of risk and reward. And so looking at how much of our portfolio is in equity, how much is in debt, how much is in fixed assets is very important as we start to think through risk. It's also going to give us a better idea of how large the corpus is. You may have, like I said, missed hidden sources of wealth in your corpus. You may have only thought about including your mutual funds and stocks, but what about your second vacation home that you're not using? That's also a source of hidden wealth, right? So actually going through the process of writing these all down, tracking them all in an Excel sheet, you may discover hidden sources of wealth. Also, we need to get a better idea of what kind of blended rate of return we can expect from our investments. So going one by one and making judgments about the future performance helps us determine, is my corpus going to give me 8%? Is it going to give me 10%? Is it going to give me 5%? Otherwise, how do I know? Because I may be invested in 15 different things. But if I need to just come up with one blended rate of return, it's very challenging to do unless I've noted it down and made judgments one by one by one. And then one of the other things that's pretty important is it helps us also analyze the cash flow that we get year on year. So if we know how much we are getting in actual cash through dividends and rental income, etc., then we can plan. If we want to shift some more of our corpus into cash generating assets, we can always do that. And then one of the most powerful and probably underutilized aspects is this. It enables us to do what if scenario planning, so we can play around with our assumptions. And this is the real power of Excel. And I'll show you how powerful it can be shortly as we walk through a dummy example of how to use Excel to powerfully sensitize on these what if scenarios. So you can say, what if I was invested in this fund rather than that fund? What difference would it make to my corpus? You can actually play around and do exactly that kind of analysis very, very easily. So let's see how Excel can help us do all of this. And you'll be amazed at how, for a lot of you that aren't familiar with how powerful Excel can be, you'll be amazed at how easy this analysis can be. So I've created a very, very simple template in Excel. This literally took me 5 minutes to create. I mean, this is how powerful Excel can be. And again, we're going to upload all our Excels that we use in this series on our website so members can download them and see how to use them. So I'm going to walk you through this a bit slowly so that for people that are new to Excel, they don't get lost. So I've just created a dummy template here, and it's enabled to, it was designed to basically help me list out a hypothetical corpus in a manner that we discussed, right? So here I have different rows that for each asset, they're going to be listed out row-wise. Here I have the asset type. So how much of the asset is considered debt, how much is equity, how much is fixed. Here I have a little check column. All it does is it sums up these three columns to make sure it adds up to 100, right? Because it's got to be one of these three things. And then in these columns, I'm basically calculating the actual allocation in my portfolio. So how much is the current value of that asset? How much in return do I expect from that asset in the future? And how much of a cash dividend is it paying, if any, right? And then this last column is just giving me a percentage of the total. So I know how large a percentage it is of my total portfolio. And then these last few columns I'll get to in a second. Ignore them for now. Let's just proceed in filling this out for a hypothetical person. So let's say that I had a portfolio that included one equity mutual fund. Okay, so it's an equity mutual fund, so 100% of it is equity. Let's say the current value of that is 30 lakhs. Okay, we'll get to return expectation in a second. And dividend in a second. Let's just keep filling in. Let's say I also have a balanced fund. Now it's a balanced fund. So let's say 70% of that is in equity and 30% is in debt. And let's say that that's also 30 lakhs. And let's say that I have a debt mutual fund, right? And so the 100% of that is debt. And let's say that that's also 30 lakhs. Then I have fixed deposits, cash in the bank. So fixed deposits is going to be 100% debt. So is cash. And let's say that that is, I have only 5 lakhs sitting in cash. And I have, let's say, 10 lakhs sitting in fixed deposits. And let's say I have a second home. And in that, I have, it's all equity. And I have 25 lakhs in that home. And so now I've filled out my corpus details, right? And I can see that I have 1.3 crores in current value in that corpus. So I think if I sold that second home, I could get 25 lakhs of profit at the current rates. And these are where the value of the mutual funds are at the current rates. And this is how much is in the FD. And this is how much is in my bank account. Now, let's try to just put in some hypothetical return expectations. So this is and we'll discuss how to estimate return expectations in future classes. For now, let's just put in reasonable numbers here, but I'll give you some tips on how to sort of sanity check these and come up with these numbers as we start to go into more advanced classes. But for now, let's just say the equity mutual fund, I expect to generate 12% return. Let's say that it's in a growth option, so no dividend. The balanced fund, let's say I expect to return 8%. Dividend also, let's say 0. The debt mutual fund, let's say 6%. And let's say that I'm getting a dividend of 3% on the fund and 3% is getting reinvested. And fixed deposit, let's say is paying me 4.5%, and all of that is coming in cash. So all of it is being dividended to me. Essentially, it's interest I'm receiving. So all of that is coming to me in cash, so 4.5%. And cash in my savings account, let's say I'm getting 3%, and all of that again is coming to me in cash flow. So 3% goes into the cash dividend. Second home, let's say that I'm renting it out to somebody. I'm getting a 3% rental yield. And let's say that I expect a little bit of appreciation on the house. So maybe I'm expecting a 6% return on the house. Okay. Now I've put in all these different kind of assets. And if you had a portfolio like this and someone asked you, what kind of return do you expect you're going to get on your portfolio? You would be unable to answer that without doing something like this. But with doing just this little bit of work that we've done, Excel is giving us all the answers we need. And again, you can download the Excel, see my formulas. And if you have any questions, just write into us. But basically we can tell that on a blended average basis, my corpus, given the allocations I have here and the returns I expect that each of these things is going to provide, my corpus is going to give me a 7.62% return under these assumptions. And it's going to give me 1.7% in cash every year. So that tells me a lot of information. Now, if we look at these summary statistics that I've calculated below, we can get some more information. So what else do we know? Sorry, the second home I'm actually going to classify as fixed, not as equity, because it's a little different than something liquid like a equity MF or balanced fund. So we can tell here that this 1.73% cash dividend, how much does it result in actual cash flow? So here's this number. It's basically 1.3% times the corpus size. We can expect 2.3 lakhs in annual cash income from this corpus. And in addition to that, we're going to get that 7.62% return, including that cash dividend plus appreciation. And if we look at the risk composition 40% is in debt, 40% is in equity, and 20% is in fixed assets. Now, I'm going to talk next class about how you analyze risk in more depth than this, because right now these are just percentages. How do we know if they're good or bad? We're going to deal with that next class. I'm going to give you a framework for how to incorporate risk into this analysis. Now, let's say that I wanted to know, what if I change these numbers, right? And I wanted to allocate more to equity. How would that change my corpus? So let's say that, okay, my second home is still going to be 25 lakhs. Cash is still going to be 5. Fixed deposits, let's say, is still going to be 10. But I'm going to move my balance, and debt I'm going to keep at 30, but I'm going to move my balance fund into equity. So that 30 lakhs sitting in balanced is going to go into equity. So my corpus is still at 130 crores. There may be some tax nuance to this. Let's ignore that for now. But my corpus is still at 1.3 crores, right? And my return expectations under this new scenario are now 8.54%, right? So I can see how that's changed this math, right? And the dividend assumption is still, the dividend amount is still 1.73% because the balanced and the equity fund were not paying me a dividend. But if I, let's say, okay, I want to reduce debt to 20 and that incremental 10 I'll put into equity. And you can see the dividend amount also goes down to 1.5%. And we can see, okay, under this scenario, my returns are higher, right? It's 9% I'm going to be getting on the fund, on the corpus. But suddenly my cash flow has dropped from 2.3 lakhs to 2 lakhs, right? And I can see my debt, equity, and fixed percentages have also changed a lot. And my equity percentage is much higher. It's moved from 40 to 54%. So this is an example of how easy it can be to do scenario analysis in Excel once you've gone through the work of inputting it into Excel. This is why Excel is so powerful. Now, as we make this template even more complicated and layer on more detail onto this, you'll see how powerful this can be. This is just scratching the surface of how powerful Excel can be in terms of analyzing your portfolio and figuring out, are you well planned and well positioned for the future? So that's kind of the template that we're going to walk through. And we'll keep modifying these templates as we learn more and more concepts to make it more powerful. So let's try and abstract from the Excel work that we did into a few principles that we can apply. So the first principle is simplicity is a virtue. So as you can see, every additional investment that we made had to be another item that we tracked in our Excel sheet. It's another item that we needed to stay on top of, monitor, figure out what the return is going to be for these things. So every time you add a financial product, you need to, in the back of your mind, say, is this worth the added complexity it's giving me? Every additional product you do is more work you're going to need to stay on top of it. That's why in general at Bharosa Club, we operate under the principle that you should have as few mutual funds as possible to still meet your risk return objectives. And one of the key fears that a lot of people have is diversification. If I have only 2 or 3 mutual funds or 4 or 5 mutual funds, what if 1 or 2 of them do really badly? Well, the truth is, if you pick properly and do your homework, you can have a really well-diversified portfolio with very few mutual funds. We're actually working on a tool that we'll release soon for members that's going to allow you to see how well diversified your portfolio is with the click of a button. So stay tuned on that. That'll be released, sometime once we get it done, but hopefully soon, which will help you assess how well diversified you are. But simplicity is a very, very good thing in general in finance. We tend to go the opposite extreme and get too complicated. The next principle is dead assets should be removed and converted to productive assets. So we talked about how the major benefit of doing this Excel work is you may find hidden sources of wealth in your portfolio. And chances are, if you forgot about them as a source of wealth, you're probably not achieving a good return on them in the first place. So let's take an example. Let's say I have a second house that I barely visit. I bought it in, let's say Himachal Pradesh, and I thought it'll be a great vacation house. And and I'm going to use it. But I ended up never going. And when I did this corpus analysis, I realized, you know what? I'm not using this house and I'm not renting out this house. So what's the point of keeping it in my portfolio, right? So let's see what unlocking the value of that can mean to a portfolio. So let's say that I had a 1.8 crore corpus. 30 lakhs of that was in the second home. 150 lakhs of it, 1.5 crores of it was in other items that gave me a 10% return, right? And the house is only giving me a 3% return appreciation, right? And if I just reinvested that 30 lakhs, I would be generating a 1.2% annual return higher, and I'd be getting another 30,000 rupees more in cash income under these assumptions. So identifying dead assets is really, really important in your corpus. It can allow you to really improve the finances of your portfolio. So that's one of the key things that we do with our corpus analysis. The next principle that we can abstract from this: cash generating assets are valuable for more than just stability. So why did we care about how much of a dividend or how much of a cash income we were getting from our assets on a yearly basis? The reason is, at the end of the day, the corpus has to fund our expenses, right? Paper gains are going to do nothing for us when we actually need to pay our bills. We have to pay our bills with cash. Now, if too much of our portfolio is in assets that are not generating cash for us, we are counting on being able to sell them at the right time, at the right price. And as we've all seen with those markets, they're extremely volatile. We don't know when we're going to need to sell our assets, if the price is going to be good or bad. Thus, having a cash cushion, some income that's coming to us in cash, regardless of where the market is a very, very good thing. That's why things like dividend stocks and annuities are very, very useful planning tools in retirement. More than just the stability they provide, they also decouple you from the market. You're not relying on a good market to fund your expenses. So that's a great reason why they're good options for retired people. So tying it all together, we've covered a lot in terms of the Excel work and the principles. So what basically can we take away from all of this? So the corpus, again, you can think of it as your raw material. How much fuel do I have to pump into the fire? How well I use that fuel is around how well you manage the corpus. So managing the corpus means determining how we are allocating that raw material, how we think that raw material is going to perform in the future, and determining our annual cash needs and whether enough of that is coming from dividends or we need to allocate more of it into cash generative investments. So how does this tangibly benefit us? Well, it allows us to eliminate dead weight from our portfolio. It allows us to simplify our portfolios by eliminating mutual funds or stocks or homes that are, not needed in our portfolio, and consolidate our portfolio. It provides us a means to ensure we are earning a sufficient rate of return and allows us to monitor how much cash flow we're generating. So I'm going to leave you with a question that's going to tee up our next class, which is going to be focused around this question. So when we did our Excel work, it's very clear that our rate of return, our income, etc., all goes up when we choose the highest returning asset classes. So isn't the answer as simple as we should just put our money in the mutual fund that gives us the highest rate of return? And obviously that's not the answer, but the question is why, right? And this is actually a very subtle question. So the answer that most people say, well, it's risk. But what does risk mean? What is risk of what, right? If I'm in a diversified mutual fund, what risk am I taking? So we're going to be discussing that in the next class. What risk are you taking when you're investing, even in a diversified market, right? Even in markets that appear to only go up, right? What is the risk you're taking? And we're going to talk about how to measure risk and how to get analytical about risk so we can estimate how much volatility our portfolio can also see. So that's kind of what we're going to be focused on in our next class. So it's a complex problem, but there's some pretty amazing analysis you can do to get your arms around it. So we're going to be discussing what risk means, how we seek to estimate risk mathematically through things like standard deviations, what correlation means and why it's important as we analyze our portfolios. And we'll update our Excel ledger that we just built to also include risk estimations. So not only will we be able to say, we expect our annual return to be 8% or 9%, we also see a standard deviation and think that our portfolio could move plus or minus X%. So how do we answer all those questions and how do we get smart about it? We're going to discuss that all next time. So with that, I'm going to open it up for Q&A if there are any questions, and then we'll conclude.
Yeah, so there are a couple of questions.
Sure.
So one of them is that if you have extra bedrooms in your primary home, I mean, this is just an idea,
Sure.
paying guests and generate income. Similarly, you can generate income with covered options if you own stocks.
These are good points. So let's deal with the first example first. So that's actually a very informative example. So let's say that I have an extra bedroom, right? It's extra to me. So it's something that I can convert into cash with zero impairment to my life. I don't care if, let's say I don't care if I sublet that room to somebody, rent it out, right? To me, then it becomes part of my corpus, right? And in my ledger, I would actually note down extra bedroom value. I would value it at some amount of money based on how much I could get from rent from it, and then use a property multiplier to calculate that, right? And I would include it in my calculations. So I'm going to do a session in the future on unconventional corpus items like this and how to deal with them when you're doing your planning. But this is absolutely a hidden source of wealth that if you're not monetizing it, you're wasting a valuable resource that you have. Another example could be, let's say that I live in the fanciest part of Delhi, okay? And I'm retired and I used to like living there because I worked at the High Court and it's close to the High Court, okay? And now I'm retired. It doesn't make a difference to me whether I live in this part of Delhi or Gurgaon or somewhere much cheaper, right? Now, that's another source of corpus. Your primary residence can be downsized without impairing your quality of life. So that delta can also be part of your corpus. So that was a very insightful question that this person asked, and helps uncover how this planning exercise can really identify hidden sources of wealth that can make you much more secure in retirement. So the next point about options and generating extra income, absolutely you can do things like that. And option strategies are actually not bad strategies for retired people, because essentially they allow you to convert equity returns and make them more debt-like. So they allow you to get regular income from something that traditionally doesn't provide you cash income. Stocks traditionally do not provide you a steady stream of income. Even if they give you a dividend, they're generally very low, maybe 1% dividend, right? Using options, you can increase the amount of cash income you get. We can talk about option strategies in the context of retirement in a future session, but it's a very, very good point as well.
Okay. So there's another question, which is, there is a term called property rich, cash poor. What does this mean, and in the context of retirement and stuff?
Yeah, so good question. So property rich, cash poor, again, deals with something very similar to what we're talking about in terms of dead weight in your portfolio. If you're somebody, let's take an example. Maybe there's somebody that has a huge ancestral property in, I don't know, Jorbagh or something in Delhi, right? And this property is extremely valuable, measured on the market value of the property. if they are living in that property, right, and not monetizing that asset is not providing them anything other than quality of life. Now, if that person was strapped for cash, right, because that property is not doing anything to give them cash, right, they're in a situation where they're rich in property, but cash, in terms of cash, they're poor, right? So they don't have cash flow, even though they have an enormous amount of wealth. So such a person, if that existed, right, the rational thing to do would be to downsize and say, I don't need this expensive apartment. I'm very happy in a smaller apartment. I don't need to live in Jorbagh. I'm fine living in Gurgaon. I can lower my rent significantly and become cash rich, right? So by deploying that corpus in things that suddenly generate income, you're able to free up money. So that's another good question.
Okay, how would you classify gold? What kind of an asset is it?
Very, very good question. So I would classify gold as a fixed asset. And it's a very unusual fixed asset that we're going to talk about a little bit in the next class. Gold is a counter-cyclical asset. It tends to do well when there's periods of distress, and it tends to do poorly when we're having economic boom. And gold, therefore, has something called a negative correlation to other assets. And we'll talk about why that's very valuable in a portfolio when we discuss risk in more detail. But I would classify it as a fixed asset.
Okay. If a second house or a property is giving only 3% return, should it be sold and invested in stocks?
So, and we'll talk about this more in the next class. We should never be making judgments on investments solely based on the return. We always need to think about the risk return. So if this is a house that Pakka is going to give you 3%, right? As Pakka is a fixed deposit or a savings, savings account pays you 3%, then it's not a bad investment. But the reality is no house is that Pakka, right? I mean, who's gonna underwrite that appreciation of 3% is definitely going to happen. We can't bank on that, right? So the reality is, if a house is only giving you 3% rate of return, it's probably not a good investment. It's probably better to rent and free up that cash and put it into something that gives you a better return.
Okay. I think that's it. There are no more questions for today. So Sahil, maybe you want to wrap up this session.
Great. Thanks, guys. A lot of good questions that helped us take the conversation further and bring out some more points. So thanks for that. And we will continue next week with, sorry, not next week, the week after next, with integrating risk into our analysis and understanding how to think about portfolios in a risk reward basis. And that'll add a lot of rigor to our analysis. So hopefully you guys play around with the Excel and get used to putting your own details in Excel. That's really the heart of good planning. So thanks, guys. Bye-bye.